Imagine a world where governments borrow money they never intend to repay, just to keep their countries running. A world invented in 1694 and still powering the modern economy. Today, over $30 trillion in United States debt alone is owed not to mysterious outsiders, but to banks, funds, and pension plans counting on endless interest. But if so many people benefit, why cannot we ever get rid of debt? And what hidden costs are we all paying for this financial balancing act? The answer starts with a single idea that changed everything. In 1694, London's financial elite gathered behind closed doors to solve a royal problem. King William III needed money, and fast. England was deep in war with France, and the treasury was empty. Enter William Paterson, a Scottish merchant with a plan that would rewrite the rules of finance. Paterson proposed a new kind of bank, the Bank of England, not just to store gold, but to lend vast sums to the government in exchange for a promise. The government would pay interest, not just for a year or a decade, but forever. These were perpetual bonds, government IOUs with no end date, paying steady interest to anyone who held them. Investors lined up, enticed by the promise of regular payments backed by the crown itself. Some critics warned that this system would chain future generations to endless payments, with no plan to ever pay down the original debt. Still, Paterson's idea took hold. The bank's charter locked in the perpetual interest clause, and soon government debt became something you could buy, sell, or inherit, almost like property. This was more than a quick fix for royal finances. It was a blueprint for modern debt markets, where governments could borrow huge sums by offering a stream of interest instead of ever repaying the principal. The logic was simple. As long as the government kept paying, investors would keep holding and trading these IOUs debt. Once a temporary burden, became a permanent feature of national life. Nathan Rothschild did not invent government debt, but he made it move. In the early 1800s, as European states scrambled for cash to fund wars and rebuild economies, Rothschild's London office became the nerve center of a new experiment, turning sovereign IOUs into a global commodity. The method was simple but powerful. Rothschild would buy up massive blocks of government bonds at a discount, sometimes from desperate monarchs or ministers in cities like Berlin or Vienna, then resell them through his network of agents and brokers across Europe. Each sale brought a tidy profit, but more importantly, it created a liquid, interconnected market where bonds could be traded, repriced, and held by investors from Paris to Amsterdam. The 1818 Prussian bond issue set the standard. Rothschild coordinated a £5 million loan to Prussia, offering 5% bonds in 5 cities at once. Interest payments were standardized, and investors could buy or sell across borders. The family's branches in London, Frankfurt, Paris, Vienna, and Naples worked in near-perfect sync, ensuring that a bond bought in one city could be cashed in another. This was a revolution. Government debt was no longer a local affair. It was a pan-European market, with prices and risks shared across borders. Rothschild's approach also changed the stakes. When the British government needed to finance the fight against Napoleon, Nathan quietly accumulated consols, British bonds, during the panic after Waterloo. As confidence returned, he released them back into the market, capturing enormous gains as prices soared. But the real legacy was systemic. By making debt tradable and liquid, Rothschild's model tied the fate of nations together. When one government wobbled, investors everywhere felt the tremors. The age of isolated crises was over. Debt had become a web stretching from royal courts to the pockets of ordinary investors, and the world would never be quite as safe or as simple again. In October 1907, panic swept through New York's financial district. The Knickerbocker Trust, one of the city's largest institutions, shuttered its doors after a failed attempt to corner the copper market backfired. Word spread fast, and depositors lined up in the streets, desperate to pull their money before it vanished. By the end of the month, trust companies across the city were losing millions in deposits each day, and some saw half their reserves wiped out in a matter of weeks. Interest rates on overnight loans spiked from 9.5% to 100%. At that price, no one wanted to lend, and the entire system teetered on the edge of collapse. With no central bank to step in, the fate of the American economy rested on the shoulders of one man, J.P. Morgan. Morgan gathered the city's top bankers in his library and locked the doors. No one would leave until a rescue plan was in place. Over the next days, Morgan and his circle deployed $25 million in emergency funds, picking which firms would survive and which would fail. It was a private bailout on a scale never seen before, but even Morgan's resources had limits. The crisis exposed a glaring problem. The country's financial system had no backstop. If Morgan had not stepped in, the runs could have spread nationwide. Congress took notice. The Aldrich-Freeland Act of 1908 introduced emergency currency, but it was only a stopgap. Lawmakers sent Senator Nelson Aldrich and a commission to study central banks in Europe. Their research led to a bold proposal, a new institution that could inject cash into the system during a panic, a lender of last resort. In December 1913, President Wilson signed the Federal Reserve Act, creating the Federal Reserve System. For the first time, America had a public institution ready to backstop the banking system, stabilize credit markets, and keep the gears of finance turning, even in the darkest hours. August 1971. Richard Nixon, facing mounting pressure on the US dollar, announced on national television that the United States would no longer convert dollars to gold. This single decision cut the last tie between paper money and any physical reserve. From that moment, dollars and almost every major currency became fiat money, backed only by government decree. The constraint of gold was gone, and with it, the old limits on how much money governments and banks could create. Modern money doesn't begin in the mint. It starts with a promise, a loan. When a commercial bank approves a mortgage or a business loan, it simply credits the borrower's account with new money. The Bank of England explained that whenever a bank makes a loan, it simultaneously creates a matching deposit. The borrower spends the funds, those dollars become someone else's deposit, and the cycle repeats. This isn't just shuffling cash. It's manufacturing money from thin air, as long as borrowers keep coming and banks are willing to lend. Reserve requirements, the rules about how much cash banks must keep on hand, are just a small break, not a hard stop. Central banks, too, have found new ways to pump money into the system. After the 2008 financial crisis, the Federal Reserve and the Bank of England began buying trillions of dollars worth of government bonds and other assets, a process called quantitative easing. Each purchase created fresh reserves for banks, making it even easier to lend. In the decade after 2008, the Fed's balance sheet ballooned from under $1 trillion to over $4 trillion. Governments, no longer limited by gold or the physical movement of cash, could borrow and spend on a scale once thought impossible. The old boundaries had vanished, replaced by a world where debt could grow as far as the political will and the appetite for risk would allow. The world's debt is scattered across a vast network of powerful institutions, each collecting a steady stream of interest payments. The Federal Reserve holds about 15% of U.S. government debt. Its balance sheet is swollen by years of buying bonds to keep markets stable. Mutual funds, which manage the retirement savings of millions, own roughly 18%. Banks, always in need of safe assets, claim another 10 to 12%. Pension funds hold 7 to 8%, securing future payouts for teachers, firefighters, and office workers. Foreign governments and investors, led by Japan, the UK, and China, own the largest single share, 32%. Every year, hundreds of billions in interest flow out to these creditors. The money supports retirements, props up financial systems, and fills the coffers of foreign central banks. In this system, debt isn't just a burden, it's an income stream, with nearly every corner of the global economy holding a stake. Every year, governments and households face a choice. They can pay off old debts or take out new ones to cover the bills. Most choose the latter. This process, rolling over debt, means borrowing fresh money to pay back what is due, plus interest. It sounds like a clever workaround, but it locks borrowers into a cycle that is hard to escape. For governments, interest payments alone can swallow up hundreds of billions of dollars a year, money that could have gone to schools, hospitals, or infrastructure. As debts grow, there is less room in the budget for anything else. Economists call this shrinking fiscal space. When too much money goes to creditors, public services get squeezed, and the risk of sudden instability rises. If investors start to worry a government cannot keep up, borrowing costs spike, making the problem even worse. For ordinary people, the same logic applies. As debt piles up, interest eats away at paychecks, and options narrow. The more we depend on rolling over old loans, the harder it becomes to break free. Debt isn't just a number, it's the backbone of today's economy, binding nations, banks, and households alike. As global debt now tops $300 trillion, every decision about borrowing shapes the world we inherit. The real question: who truly benefits when debt becomes the system itself?